Hey everyone, welcome back to the Mustard Seed Bitcoin podcast. This week I have on Joe Consorti again. Joe, welcome.
Joe, thank you for having me on. Excited to have more regular cadence to these Bitcoin and macro updates here.
Absolutely. I think the audience really enjoyed your take on markets, Bitcoin, macro, so on and so forth. So we're going to try to do these more regularly to just kind of get in get our bearings on like what the market's doing, what our outlook might be, and just how you're thinking about markets overall. So this is going to be a fun conversation. Maybe we can start with recent Bitcoin price action. Earlier this week we saw Bitcoin, as we pointed out on Twitter, had its worst single individual day in all of 2025, or second worst single individual day in all of 2025. What do you make of what's going on in Bitcoin right now?
Absolutely. So essentially, like, this is just a continuation of the theme that we've seen all year and the theme that I mentioned on last episode, which is that there's this huge redistribution in Bitcoin supply going on, like bigger than we've ever seen at any other point in Bitcoin's history. Obviously, long-term holders distribute into strength and short-term holders purchase into strength. That's typical of all of Bitcoin cycle tops, which typically are bull market, these huge blow-off tops where Bitcoin has a run that lasts, anywhere from 6 to 12 months. And then we have a huge crash afterward. It's much different this time around because this supply redistribution has been taking place since the start of the year. And so if you take a look from the technical analysis perspective and you say, okay, how does this 1 day percentage change line up with the rest of the year for Bitcoin? And you'll actually notice, and I can actually share my screen here, that this is the second worst day for Bitcoin from a percentage return basis in the entire year, right? So the last worst day that we had, and you can see on this chart, is all the way back in March. So up here, these are days when Bitcoin went up. These are days when Bitcoin went down. You can see here that peak to trough, Bitcoin fell 6.1% on the day. Now, relative to Bitcoin's all-time high, we had a maximum drawdown of only about 20%. Now, one thing to note is that throughout this entire cycle, we've had two separate 30% plus drawdowns in Bitcoin. So these are typical of a bull market, right? You have these major drawdowns and then price resumes trending higher. We've already had two of those corrections. So this correction relative to the other ones actually isn't as large. And so that tells me that sellers cannot push this thing below $100,000 for very long. You can see up in the top left there, the price is moving around. We're already back above $103,000. So we've managed to bounce off of $100,000 quite cleanly. We've been able to reclaim the 300-day moving average. All of these very key levels that I had mentioned yesterday. I did a video yesterday. If Bitcoin closed underneath $100,000 for a protracted period of time, then it would be disconcerting and I would change my outlook over the next couple of months to one that's more bearish, right? However, the fact that Bitcoin was once again, just like it did in the middle of October, able to reclaim that level and bounce off of that level very quickly, it tells me that there's still plenty of buy side to absorb the sell side. Now, the fact that Bitcoin's prices dragged down the last couple of weeks, that's kind of lining up with what equities have been doing over the last 3 days since futures opened on Sunday. However, it is indicative that the selling pressure is starting to get to buyers, right? So for me, I will be on red alert over the next couple of weeks to make sure that these levels hold, this $100,000 level. And the key level to watch is $95,000. The reason being, that is the short-term holder cost basis, if I'm not mistaken, or the average network cost basis, rather. That is the key level to watch. If we break $95,000 and continue falling below it, then chances are we're in for a next couple of a series of months after this one where Bitcoin trends lower rather than bouncing up and resuming higher. So for me, the fact that Bitcoin was able to make a resounding bounce after the fact is really encouraging, despite yesterday being the worst, the second worst day for Bitcoin in the entire year since March.
Yeah, I think that was really good. One thing that I was kind of surprised about when I saw that original chart was yesterday, I guess, was worse than that major liquidation event that we had maybe, I guess, a few weeks ago when Trump had that tariff announcement on a Friday afternoon. But I guess like that was more of like a crypto liquidation event, maybe rather than a Bitcoin, although it was a little bit of both. Any thoughts on like how the severity of that drawdown compared to, something that people deemed pretty catastrophic for the crypto world?
Sorry, could you repeat that?
Just like comparing, or the recent drawdown that we just had to that major liquidation event that we had in October,
Yes.
where the crypto market, completely melted down, and a lot of altcoins went to zero. Are you like surprised that yesterday was like worse than that day, or is it not a big deal because that was mainly like crypto market meltdown? Like, how are you thinking about that?
Right. That's a really good question. So, from a percentage basis, obviously it's larger because the absolute amount that Bitcoin fell was more or less the same in one day. So, it isn't really surprising to me that Bitcoin managed to fall that much. Also, there is a little bit of a disparity between the liquidations data that I look at and the data that I look at on the Bloomberg terminal, because the data on the Bloomberg terminal is in UTC-0, whereas the data on the liquidations terminal is New York time. So there is a little bit of a difference. So depending on what time zone you look at, it may have actually been larger or it may have been smaller. Regardless, it was still within, striking distance of the exact same day. The key difference is that the yesterday was dominated mostly by spot selling, mostly by capitulation from short-term holders rather than forced liquidations. So that's the key disparity. We had this massive reset on October 16th. I think everybody can remember where they were. I was sitting right here at my desk as per usual, looking at the charts. Actually, I had just finished dinner. I looked over my shoulder. I'm like, oh my goodness, what's happening with Bitcoin? I looked at the futures data and I saw, oh my goodness, there are like several $100 million worth of liquidations in 15 minutes. And then in 45 minutes, $278 billion worth of value is gone. Yesterday, it was actually spot capitulation, which is something that's actually quite healthy for Bitcoin. What you want to see before you ascend higher is people bailing, is people jumping ship, people saying, I'm done with this, right? That generally is indicative of a reset in sentiment that is really, really healthy for price. What you don't want to see is a continuation of that. What you don't want to see is continued spot selling. And so the fact that we were able to see spot selling followed by a massive rally, I wouldn't say massive, but at least a rally in price, that's very encouraging to me. So that's the primary difference, right? Yesterday was spot-driven capitulation. October 16th was a massive forced liquidation event. Look, the reason I'm so bullish continually over the next couple of months is because of the macro backdrop, right? Bitcoin is an asset that exists in a universe of other assets. I've said this numerous times. And, even though equities are kind of stumbling right now, it could very much be an exhaustion type event, right? Or we get this minor reversal in equities as a result of this insane rally that they've had over the last couple of weeks before it bounces back and resumes the trend higher, right? If that is the case, then all asset prices are moving higher over the next couple of months. I just don't see anything in the macro backdrop that would lead me to believe asset prices, Bitcoin included, are headed lower. The main point of concern was this acute banking stress that people thought we were seeing. We were seeing a spike in the spread between two key funding rates and overnight lending markets with banks, but that seems to have abated for the time being. And so I don't think we're in for a March 2023-esque scenario where there's a liquidity crunch at banks, and as a result, the Fed is forced to intervene. It doesn't seem like that is a huge risk for the time being. It seems Bitcoin was worried about that for quite a while, right? It's been trading sideways, and then it managed to trade down over the last couple of days. But the last couple of days has just been trading down with equities. And so in my mind, if equities resume higher, Bitcoin will too. But I do believe there may still be some sell side that we have to churn through at that $110,000 level. And this is the last thing I'll say here. Every time we have reached that $110,000 level, there is an immense amount of sell pressure. And I was going to point this out over the weekend, but I didn't have time to actually put the chart out. If you took a look at Bitcoin's price action, just on a 5-day basis or a 1-month basis, the volatility continues to decrease. So we continue to be at this level. Every time we hit this $110,000 mark or $115,000, there's this massive amount of sell side that brings us down right underneath. And so in my mind, it seems like limit sell orders are staggered right around that $110,000 to $120,000 range. And so any buy side that comes in, these long-term holders that we've talked about are looking to sell and get out of the market. And we can talk about some of the reasons as to why that's happening now and why it's so consistent. Whereas in prior cycles, it was just a blow off top, and then Bitcoin, crashed 50 to 60%. And then we built the base from there. I think it's very, very interesting, and I'm happy to discuss why we're consolidating at the all-time high. Whereas generally speaking, you see this kind of supply rotation at the bear market lows.
Yeah, I do want to talk about like long-term holders distributing some of their coins. But first, I kind of want to touch on like current market sentiment.
Mhm.
Right now, Bitcoin down maybe 20% or so from its all-time high. US stocks, US equities, pretty much, down a little bit, but still pretty much near all-time high.
Mhm.
Yet from my perspective, and maybe this is just me, Bitcoin community sentiment feels fairly down. And even like US stock and like, the broad US economy sentiment feels kind of down. Do you have any, thoughts on why that might be the case?
Absolutely. I mean, one component of it has to do with the jobs market, right? There is this chart that's been circulating quite a bit. It's job creation. It's new jobs. I believe it's the JOLTS data, and then juxtaposed with the S&P 500. And a lot of people are. You can see there's a divergence between the two in about 2022. So in 2022. There was this huge divergence between new jobs created in the S&P 500, new jobs or total job openings, rather. Excuse me. That's what the JOLTS data shows was moving down, and then the S&P 500 was moving higher. Now, a lot of people were ascribing that they were giving the reason to that for ChatGPT being released, saying, "Oh, ChatGPT 3.0 was released on this day." That's actually not the case at all because it also lines up with when the Fed started raising interest rates, right? When the Fed raises interest rates, job growth falls, right? It's just a reality. The cost of capital increases. It becomes more expensive for employers to hire on new talent. And as a result, total job openings decrease. The reason financial assets were rising was a different reason entirely, right? The rates that were available in corporate bonds and in U.S. Treasuries were not high enough to attract risk capital out of equities or out of Bitcoin or out of anything like that. And so people were still bidding these things up. You pair that with this huge boom in AI, and people were piling into these trades, namely Nvidia. We were talking beforehand, it's now a $5 trillion asset. Massive growth in these AI companies because that seems to be where we're headed as an economy. And so that's kind of why you see this negative sentiment, particularly in the US economy. And that's why the Fed is cutting rates. They're not cutting rates because of price inflation. And they've said this in both of Jerome Powell's remarks, as he's now cut rates twice, and in the FOMC statement that you can go and read. They talk about the reason that they're cutting being the labor market, right? Not inflation. Even though inflation is elevated, it's still above 3% on a yearly basis. They're still cutting into it because of the weakening labor market. So that is why there's negative sentiment on the labor market side. Look, the reason there's negative sentiment on the equity side, even though I'm looking at the S&P 500 chart now, it's down only 1.73% from its all-time high. It's because people are so used to equities rising forever that whenever we see these, for increasingly smaller drawdowns, you see increasingly negative sentiment, right? So over time, it takes a much smaller drawdown to destroy sentiment. But this is particularly acute in Bitcoin. Bitcoin is down 20% from its all-time high. The Bitcoin Fear and Greed Index is all the way over to the left. We are in extreme fear territory. We have an index value of 23 as of a couple of minutes ago. So, Bitcoiners have kind of been shellacked this entire year because they've underperformed equities. Whereas equities are just really, really entitled because they're so used to prices rising forever. And then the negative sentiment in the labor market has to do with total job creation falling. To actually give numbers to these things so that the viewers can have some context. Year to date, so January 1st to today when we're filming this, November 5th, we're almost at the end of the year. Bitcoin is up only 9%. Which makes for the first time ever that on a yearly basis, Bitcoin is only up by single digits, right? Obviously, there have been years where Bitcoin has fallen during bear markets. But as far as the bull market goes, this is the first year where Bitcoin has had a single digit return. Obviously, the year isn't over yet. We're just 0.7% away from Bitcoin having a double digit return in the year. But regardless, Bitcoin is up 9%. The S&P 500 is up 15%. And the NASDAQ is up 21%, right? So generally, Bitcoin is more sensitive to the NASDAQ. So you would assume that Bitcoin should have risen 30, 35, 40% this year, and it would be at $145,000 or $150,000 right now. That's not the case. It's drastically underperformed everything else. So that's why you see negative sentiment in the labor market and the economy broadly. That's why you see negative sentiment in equities. And that's why you see negative sentiment in Bitcoin, because equities have dropped and Bitcoin is drastically underperforming everything for other factors.
Yeah, it makes a lot of sense. It's like we all know that the money is broken in a way. And so, if you actually measure equities in Bitcoin terms, well, like you're going down, right? Like Bitcoin
Mhm.
is actually, decreasing in value this year, and
Yeah.
gold obviously as well. So that kind of makes sense. Um, let's talk about, why this underperformance has persisted, I guess, this year. You brought up earlier, long-term holders have been distributing, coins that they've held for potentially a very, very long time. Why do you think that's the case? Why is that going on like right now?
Yeah, absolutely. So I'm sure you read Jordy Visser's post over the weekend that talks about Bitcoin's silent IPO. It's essentially likening what's happened to Bitcoin since January 1st of 2024 to an IPO, right? Obviously, an initial public offering is when a company goes public for the very first time. The shareholders of that company finally have liquidity. And what do? They sell into the market in order to get liquidity. Generally speaking, the time frame to IPO is anywhere from 5 years to 10 years. And Bitcoin is 15 years old now. And so what you have is OG holders, right? People who mined way back in the day from 2010 to 2015, or people who purchased and weathered so many different storms. They now have an institutional bid on the other side of Bitcoin. They now have a massive liquidity. The market now has massive liquidity in order to absorb their sell pressure, right? So effectively, there's always a price that people will sell their Bitcoin. There are more tools than ever to borrow against your Bitcoin. But for context, we're talking about people who have 10,000 BTC, 20,000, 50,000 BTC, what you would consider Bitcoin whales. Where for them, Bitcoin at $1 million and $100,000 doesn't make that much of a difference because they're already centimillionaires, right? They already have hundreds of millions of dollars, more money than they'll ever need. And for them, now is a key moment where they can exit the market, and there's finally an institutional grade bid on the other side to absorb it. That's the dynamic you've seen for the entire year. It's particularly acute this year, where Bitcoin is now around $2 trillion and it has enough of a base, enough liquidity in order to absorb the sell side from OG folks who are selling into cash. And Jordy Visser likened this to an IPO moment, right? Where again, private companies now become public, early risk takers, right? Because that's what people who start private companies are, whether they are a startup, whether they have massive funding going in. Anybody who starts a company, right? You are taking a risk. And eventually, once you get liquidity, even if you're going to be a part of the company, you still want to take some of those gains off the table. You want to be rewarded for the amount of risks that you took on. This is your reward that you've been waiting so long for. That's the exact same dynamic that we're witnessing with Bitcoin now. People may not be dumping their entire holdings, right? We don't know for sure whether or not these OGs, these people who are holding onto a large bag of Bitcoin, are selling all of their holdings. But one thing is absolutely certain, and you can witness it in the on-chain data, is that dormant coins are waking up after a long period of slumber and finally looking at a market that's $2 trillion in size, that has steady bids from institutions, from ETF issuers buying on behalf of their clients, from companies, and people who are bidding in much larger size to finally be able to sell their coins into. So that's why Bitcoin is underperformed this year relative to everything else, right? Obviously, the S&P 500 is constantly changing its weighting, is constantly changing the companies that are included in it. Same thing with the NASDAQ. Whereas Bitcoin is not. Bitcoin is one asset. And so that's why you've seen these equity indices rally so hard while Bitcoin is underperformed. Bitcoin is undergoing this fundamental change in its supply structure from people who've been here for decades to people who plan on being here for the next several decades. Now, that price action can be very demoralizing, right? Checkmate calls it chopsolidation. We also saw this last summer, but we've had an even more intense period of it this year because year to date, Bitcoin's only up 9%. So it's demoralizing. It can take a very long time, but ultimately, once all is said and done, Bitcoin will be in the hands of people who plan on holding it for the next several decades, right? So there's this passing of the torch, this changing of the guard, and that's why Bitcoin has underperformed basically everything this year.
Yeah, to me that makes, perfect sense. If you're sitting on, a large amount of Bitcoin that you're up 100x, 1000x, 10,000x, or even more, it's perfectly reasonable for you to, potentially want to diversify or, buy that house or buy the boat that you've always wanted or whatever else. And so that makes a lot of sense. And, as we've seen, Bitcoin actually, Bitcoin has historically, compounded at a 50+% compound annual growth rate. And if you put that over a long period of time, well, like you can turn a little bit of wealth into a lot of wealth. And when you have a lot of wealth, it makes sense to potentially distribute some of that wealth. One thing that I find kind of interesting, and I'm curious to hear your thoughts on this, is like some people, you don't hear this much anymore, but some people would criticize Bitcoin because it has, I guess, a high Gini coefficient where they say a small portion of people or individuals hold a lot of the wealth. And therefore, the wealth inequality within the Bitcoin monetary system is very high. Whereas, right now, and I think over the history of Bitcoin, we see natural distribution of coins and that Gini coefficient is falling over time. Whereas like in the fiat world, from my understanding, the Gini coefficient is actually rising over time. Like it's the Cantillon effect or the Cantillon effect of how, the wealthy get access to new money first. They buy fresh assets. They're the ones that kind of benefit from it. And so it seems like we're kind of like diverging into two different paths where the fiat system wealth continues to concentrate, and in the Bitcoin system wealth continues to decentralize all around the world. How are you thinking about that, or do you agree with that?
I completely agree with that, right? Because on the one side, you have an asset that's designed to inflate forever. And on the other side, you have an asset that has a disinflationary supply schedule. So the amount of new supply that's coming into the market is decreasing with time, and it has an absolutely fixed terminal supply, right? So naturally, that asset, in a world where the denominator is being debased in perpetuity, naturally what you find is that asset goes up in price forever, right? And as it does, people own, not only, number one, do people want to own more of it, people want to flock to the asset that is absolute scarcity in a world where the denominator is being perpetually debased. So naturally, the dollar value, right, or the value of Bitcoin in any fiat currency is going up. And so naturally, if you just take this as a thought exercise, people, given a fixed amount of dollars, given a fixed amount of investable income, they would own less of that asset. And so naturally, that means Bitcoin's ownership distribution goes from highly centralized or having a Gini coefficient closer to 1 to a Gini coefficient closer to 0 as that supply distributes. And that's exactly what we're witnessing right now, right? That's another way of illustrating Bitcoin's ownership dynamic that it's going through right now, where these long-term holders who may have held 0.1%, 0.5%, 1%, 2% of the terminal supply are now selling into the market. And those coins are being picked up by one ETF shop here, by a couple of individual investors here, by one institution here. And that supply is being spread out. Right. Therein, it's taking Bitcoin's ownership cohort from a lot of it is held among a few individuals to a lot of it is being held among many individuals. And as Bitcoin continues to rise in its US dollar price over time, that's going to continue to be the case. Right. So this is a natural phenomenon that is occurring as Bitcoin is monetizing and is growing from, 0 15 years ago to over $2 trillion today. Now, by the time Bitcoin is $20 trillion, $30 trillion, $50 trillion, its ownership distribution will be even more distributed, and Bitcoin will be held amongst an even wider base of holders. Now, that's not to say there won't be people who still have massive amounts of Bitcoin. Bitcoin treasury companies among them, chief among them. Strategy has well over 600,000 Bitcoin. Metaplanet has over 30,000 Bitcoin. There will still be these entities, but they will be far fewer and further between than Bitcoin has historically experienced.
Yeah, I think that was a great point. And kind of, as you were speaking, I was thinking, well, someone would probably counter, well, you see companies like Strategy, obviously the largest Bitcoin treasury company, accumulating a growing amount of the supply. I think they have 3% of the Bitcoin supply. But then I would also, the counter argument back to that would be like, well, Strategy and other Bitcoin treasury companies are publicly traded equities. It's not like Michael Saylor owns 100% of Strategy. Like they're actually constantly using their common equity ATM, issuing new shares to public markets, and they have thousands and thousands of shareholders. And so in a way, it is kind of still distributing the Bitcoin to, many people actually. If you hold, typical 401k with passive index funds, you're kind of one of the people getting exposure to Bitcoin via Strategy. So it's like, I think it's, we're probably going to continue to see, this distribution of Bitcoin, even if the Strategy continues to accumulate more Bitcoin relative to the total supply.
Of course, absolutely. Yeah, I mean, in years prior, right, Bitcoin whales were kind of the rule, right? When you talk about, 2010, 2011, 2012, people holding 100 or more Bitcoin, that was the rule. Now it's becoming the exception. Right. And that's the key. That's the key difference between then and now, kind of this institutionalization of Bitcoin as an asset. You wouldn't say it all depends on how you categorize it. Right. So owners of Strategy common stock, you can either say that Strategy owns 680,000 plus Bitcoin, or each Strategy shareholder owns X amount of Bitcoin, Bitcoin per share. Depending on how you quantify that, you could still say Bitcoin's ownership is just as concentrated as it was 5 years ago. Or you could say Bitcoin's ownership distribution is much more decentralized than it was 5 years ago. In the same way, and I think this is something that a lot more people would agree with rather than the Strategy comment, the Bitcoin ETFs, right? Would someone say that BlackRock, for instance, owns several 100,000 Bitcoin, or would they say that shareholders of BlackRock own X amount of Bitcoin on average? Shareholders of the BlackRock IBIT ETF own X amount of Bitcoin on average. And I would say the latter, right? It's just a different way of owning Bitcoin. These ETFs are highly regulated. They own Bitcoin on behalf of their clients. They're not one entity holding Bitcoin. They're one entity holding a massive pool of Bitcoin on behalf of their clients. And so we're moving from this world where the rule is that you own 100, 200, 1,000, 10,000 Bitcoin, to that being the exception. Right? Very few folks are going to continue holding that large amount of Bitcoin into the future. There will be other key selling moments when Bitcoin hits 150,000. Perhaps some people who've been holding since 10,000 are going to wait till $1 million. There will always be this kind of supply distribution because everybody always has a price where they're willing to swap their Bitcoin back into fiat, where they've created generational wealth, or at least take the majority of their gains off the table. But as Bitcoin grows and monetizes, the supply concentration of Bitcoin is going to become the exception. It's only getting more distributed as time goes by, as more methods of owning Bitcoin continue to come to the fore, and it opens up to a wider array of people. MicroStrategy's preferred stocks are another prime example. It's opening that up to a massive fixed income market. Bitcoin's ownership structure is only getting more distributed in terms of the amount of people who are holding some kind of Bitcoin proxy or Bitcoin itself.
Speaking of the Gini coefficient and just wealth inequality overall, we just saw last night actually Mamdani, who was elected to be mayor of New York City. Obviously, he's one of like the most prominent, very clearly socialist figures. What do you make of that? Like, is that a symptom of broken money? Is that just the downfall of New York City? Like, what are you thinking about?
Very well said. I'd say more so it's the downfall of New York City. I think two things, right? Demographics matter quite a bit. And if you take a look at New York's native-born population versus its foreign-born population, that number has increased drastically over the last several decades. So that is something to do with it, right? Those are folks who will largely vote Democrat as a result of being able to get temporary government assistance programs and things of that nature. So I think demographics play a much larger role in it than perhaps the money does. But the money also does play a role in it, right? Because you do have native-born New Yorkers who are citing the reason as to why they voted for Mamdani as being, the rent is too expensive, the groceries are too expensive. And so as a result of money that is becoming less valuable over time, money is a communication mechanism. When it falls in value over time, we can't communicate properly, right? Whereas prior to 1971, 1950, for example, a home was 2 times the average annual wage. Now it's nearly 10 times the average annual wage if you actually want to live in a suburb that's worth living in, right? 10 times the average annual wage. People will take the median home price and they'll say, well, no, it's actually only 7 times the annual wage. That's still crazy, but taking the median home price is also looking at places that are nowhere near a major city, and someone could earn nowhere near the median income by living there unless they worked remotely, right? So the real gap between home prices and incomes are actually much closer to 10. Right? If you want to live in a municipality that's close to a job where you could earn the median income or higher. All that is to say that because the money is becoming less valuable over time, it's kind of branched us off into 2 different schools of thought. The first school of thought is that, well, we actually haven't had capitalism since 2008. We've had crony capitalism, wherein all of these major financial institutions get bailed out using taxpayer money and freshly printed money. That's socialism, right? That's plain and simple socialism. We've had these temporary government assistance programs that are now used by I think it's 13 or 14% of the United States population. That's insane. That's socialism, right? So we haven't actually had capital. I know it's a statement that gets used oftentimes on the left. They say, well, real socialism hasn't been tried yet. Well, the reality is that we have had increasing amounts of socialism since 2008. You look at the proliferation of these government assistance programs. You look at the proliferation of Obamacare, and you look at these too big to fail banks and other major financial institutions getting bailed out. You talk about the Cantillon effect. That's another great example of it. So people who are closer in access to the money printer have socialism. for everyone else, particularly the middle class, or we also have socialism, but for everybody else, you have capitalism, right? For very, very wealthy people, you have capitalism, and for the less wealthy, and namely the middle class, you have socialism, right? Both of our incomes, 40% of it goes to the U.S. government every single year. That's insane. All that is to say, these two worlds that we've moved into are financial optimism and financial nihilism, right? Bitcoin allows folks to have financial optimism, whereas the financial nihilists essentially say, okay, the world is going to the shitter, pardon my language. I need to take more of rich people's money in one way or another. So Mamdani being elected, all that is to say, Mamdani being elected is simply a symptom of financial nihilism and demographic change coming to its natural end state, right? Where you're going to elect a guy who hasn't held a real job whatsoever. His parents are fabulously wealthy. He just became a U.S. citizen, I think 7 years ago, and he doesn't have a PhD. He doesn't have any qualifications that would allow him to be mayor. But what he has done is he has successfully convinced people that in order to get into prosperity, we can do it by taxing ourselves. And that's not remotely true. So look, I think it is a symptom of financial nihilism, partly. I think more so it's demographic change. And I believe that over the next 4 years, people are going to witness the destruction of New York. Largely, the middle class will be hollowed out as a result of whatever policies he can get through. And ideally, it swings back in the other direction. But we really are seeing this huge divergence into communism and nationalism, right? These are the two forces that are at play in the United States more so than ever. So that's my commentary as far as Mamdani being elected is concerned. It's partly broken money, but largely it's other things.
Yeah, I agree with you where you mentioned that we're seeing like two clear kind of political classes or political ideologies, communism and nationalism. Do you see like this, socialist / communist like movement gaining traction, or is this like a one-off event that, is mainly due to demographics and won't persist in other cities or, for the U.S. federal government as well? Like, how do you think about the evolution of politics in America?
Right. So I believe that it will only become more popular, but I think it's only going to become popular in dense urban centers. I don't think what happened in New York City is a reflection of where we are headed as a country. Look, I mean, New York, I don't want to say past the point of no return, but you look at places like California and the immense demographic change that has caused that state to flip from a Republican state with huge amounts of national pride to a Democrat state that chances are will never be flipped. The same is true for places like New York as a result of largely New York City and New England as well, right, where I live. So I wouldn't say that what happened in New York City is indicative of a broader trend in the country. It wasn't just New York City either. Every state city that had some kind of election yesterday, whether it's Pennsylvania, whether it's New Jersey, all of them are blue states, right? And so in Virginia, for instance, prime example, largely blue state, blue governor won, no big surprise there. So I wouldn't say that what has happened, and New Jersey as well, it's an even better example. Blue state, blue governor won, wasn't necessarily going to be a close one. However, the Republicans did gain traction relative to the last gubernatorial election. So I wouldn't say that what happened yesterday, whether it's New York City or New Jersey or elsewhere, with the Democrats basically cleaning out the table, is indicative of a broader trend in the country. I think the election in 2020 was a referendum on what has happened over the last decade plus, which is this massive Democrat wave, this sweeping proliferation of socialism and communism, though it's not called those things. And so I think more and more this country is trending in the direction of nationalism, of real capitalism, and that being the function by which we increase individual prosperity rather than a movement into socialism. I believe that what happened in New York City and New Jersey, New York City in particular, that is a one-off. I think they will reap what they've sown over the next couple of years. And at the margin, I think it's only going to increase the amount of folks who are moving to the other side, but that remains to be seen.
Yeah, that makes a lot of sense. I kind of want to shift back a little bit towards markets again. Thinking about, and this is kind of related to what we were talking about with like the Gini coefficient in a way, we've seen a lot of concentration within the S&P 500. I think like the top 3 companies in the S&P 500 make up like 20% of the entire index at this point, which is, interesting, kind of scary. It's cool that they're like AI technology type companies. Like maybe that means like we're continuing to accelerate as a country and like as a species. but it's also like, okay, our, a large portion of America's retirement is bet on the success of Nvidia, Microsoft, and Apple or Amazon, whoever the third one might be at this point. But what do you think about that extreme concentration in U.S. equities? Like, is it a problem? Is it a good thing? How is it going to end? Like, what are you thinking about?
That's a good question. I'm going to share this chart. This is between the equal weight S&P 500 index and the S&P 500 index, and this is normalized over the last 5 years. So if you take a look in white, this is the equal weight S&P 500 index, and you'll note that largely these two were moving in tandem more or less until about the start of this year. Once we had the April drawdown that affected U.S. equities and Bitcoin as well, the S&P 500, right, obviously, which changes its weights all the time to the better performing players, has increased 93% over the last 5 years, whereas the equal weight S&P 500, actually, it looks a lot like Bitcoin, right? If you can visualize the way that Bitcoin has performed this year in white, the equal weight S&P 500 looks a lot like Bitcoin. And so what that tells you is this is a good illustration of what you just talked about, which is that the S&P 500 U.S. equities, they're becoming concentrated among a few key players, namely the Mag 7. I guess you could throw Nvidia into the Mag 7 at this point, where it's primarily AI and tech that are driving the entire U.S. equity market. Now, concentration can be a good thing. It can also be a bad thing, right? When you're concentrated in a key number of financial assets that have earnings that support their prices or earnings that support their price appreciation, then concentration isn't necessarily a bad thing. Ultimately, there will be drawdowns, there will be sell-offs, earnings will peel back, and as a result, the equity prices ideally will come down. But concentration without that earning support is a bad thing, right? If Nvidia were trading at these insane multiples without the support of, on a quarterly basis, their revenue increasing, then that would be a little bit disconcerting. And so that's why I kind of take issue with the Michael Burrys of the world who are calling what is happening now a bubble, because the main difference between what happened in 2000 and what happened today are that earnings actually support largely these valuations. And so, look, I think that concentration without the support from real earnings underneath it is a bad thing. But ultimately, concentration does leave you more exposed to, if something bad were to happen to these companies, more of your portfolio is in the drink. So I think it begs a question for investors, like, what is their long-term goal? Is their long-term goal to generate wealth and to take calculated bets in order to generate that wealth faster, or to have a more steady and reliable increase in their wealth without necessarily the risks that are associated with concentration, right? Because the moment you see any kind of underperformance from Nvidia, from Meta, from Microsoft, from Apple, all of a sudden the S&P 500 can come crashing down because so much of his weight has been allocated to those players. So really, I think that for the time being, it's a good thing. But the moment that earnings stop supporting the massive growth in these equities, that's when it flips into becoming a bad thing, which also kind of brings about the value proposition of Bitcoin. It doesn't have earnings, right? Its value proposition is quite simple. It is an absolutely scarce monetary asset in a world where the denominator cannot stop being debased, right? We live in a credit-based economy where rates necessarily need to come down, where the velocity of money is determined by creditworthiness, by interest rates, by all of these things, and the system relies on perpetual expansion of that credit, which necessitates the US dollar to be worth less every single year. So the value proposition of Bitcoin is that it's just the perfect hedge in that environment. That's it. Right? It doesn't carry corporate risk. It doesn't carry balance sheet risk. There's no risk if Bitcoin has an earnings call that misses expectations and all of a sudden it sells off 5 to 10%. Those risks aren't present. So I'd say in this world of constant, it really is it's bad news for folks who've been detractors of Bitcoin for the reason that it has no earnings, right? Because what you're seeing now is that there's this massive concentration in U.S. equity markets among a few key names. So for me, it's fascinating to watch. I think a lot of traditional investors are being thrown for a loop this year. And we're moving into an era where concentration among a few key names is the MO. It's just the standard way the market operates, and people are going to have to adjust the way that they allocate accordingly.
Yeah, I definitely think it could be. I mean, it's obviously been an increasing trend, and if AI is what people think it could be, then obviously these are going to be absolutely massive companies. One thing that's interesting to me, just thinking back, the history of markets, like I remember when Apple became a $1 trillion company. I think it was either 2018 or 2019, $1 trillion, and people back then were like, this is crazy. Like, how can a single company be worth $1 trillion? And now Nvidia worth approximately $5 trillion in, 6 or 7 years. it's like mind boggling. It's kind of crazy to think about like how fast, a single, or how large a single company could become. And it also kind of, I guess, shows like the debasement of the US dollar. Like this is an exponential train where, dollar supply grows by roughly 8% or so per year on an M2 basis. And it's like things, everything's kind of going to go up forever. High quality assets are going to go up forever. And the largest company in the world, whichever one it might be, is also going to keep going up forever.
That's exactly right. Nvidia is they position themselves extremely well for the next decade plus. Obviously, home computing has been a huge trend in American life and life globally over the last 3-4 decades, but it's particularly accelerated over the last couple of years. And people are beginning to realize that it matters. The companies who are producing the products for the end user matter far less than the companies that are producing the components and the technology in order to make those things happen. And that's why Nvidia has skyrocketed, right? Over the last 3 years, rather, AI, right? The main necessity for AI is computing power in data center space, and graphics cards, GPUs, which formerly, they were components of Apple computers or Windows computers or any type of desktop computer in order to make its graphics engine run. Now, more than ever, there's this massive sudden value proposition for graphics cards, and Nvidia, having positioned itself as the key player in the market for graphics cards, it is now a $5 trillion company. So it's no surprise to me. I think this is a trend that's going to continue accelerating over the next 5 years. And I think it's only going to encroach further on American life. And that's a good and bad thing, right? I believe that artificial intelligence, if used correctly, can be a massive complement to your workflow, right? The people listening to this now, if you can leverage AI in your daily life to, let's say, complete tasks or complement the work that you're already doing, then it's a huge tool, right? It's a tool that can allow you to accelerate your path to get to where you want to go, your working capacity, whatever it may be. But if you use it as a supplement to your brain, right, then it can become hugely detrimental, in the same way that if you, kind of grow this third limb by using your cell phone, it can be hugely detrimental. So I think AI applications are set to only expand and become more innovative and more useful and utilitarian for companies and for individual people. But I do believe that, as with anything, it's something to use in moderation and be cautious of, and be mindful of the way that you're using it.
Yeah, I think that was very well said. Like AI is a tool, and tools can be powerful. AI is a very powerful tool, and powerful tools can be used for both good and evil, for yourself and for the world. It kind of reminds me of Bitcoin treasury companies, or amplified Bitcoin. It's like that's a powerful tool, and it can work both ways. It's not just like it goes up only.
Mm-hmm.
What did you think about this? Was back on actually Halloween, I believe. Secretary of the Treasury Scott Bessent made a tweet about the Bitcoin white paper, or he was mainly about Bitcoin, I guess, and he was saying Bitcoin doesn't shut down, even though the U.S. government does shut down. What did you make of that?
Yeah, well, first thing is that, I got what I voted for, right? Again, which is nice. But the second thing, this is a major shift, right? You can recall Janet Yellen just 4 or 5 years ago talking about how Bitcoin was speculative and it was dangerous and that we needed to regulate it into oblivion effectively. And now, just 5 years later, look at how much can change, right? We had a Treasury Secretary that was extremely against Bitcoin, largely, to a Treasury Secretary who's extremely accommodative of Bitcoin, and an administration more broadly that is looking to bring more of that business activity to the United States and create a more accommodative framework for people to own it and businesses to operate that work in that industry. He said 17 years after the white paper, the Bitcoin network is still operational and more resilient than ever. Bitcoin never shuts down. The Senate Democrats could learn something from that. So a little bit of a jab at the Democrats at the very end of it. But I think the larger signal is him tweeting that out to begin with. Some people can say that that's just fan service. That's just pleasing to the crowd. It's just telling the voters and, giving them a cookie and telling them to go away, essentially. But I think it's much broader than that, right? I think it's a seismic shift in Bitcoin's acceptance as a major macro asset. When you have the sitting Treasury Secretary of the world's single most prosperous nation tweeting about Bitcoin, that is a huge regime change from where we were previously. So I think it's just another development in a long line of developments where Bitcoin has moved from niche to much more mainstream. It plays into all of the price action that's happened this year where the ownership distribution of Bitcoin is shifting. So I think this is just another event in that seismic shift in the way that Bitcoin is treated publicly and where its supply is held and by whom its supply is held.
Yeah, I think it's a really good point as well. One thing that I've also heard Besant say is he believes that next year, 2026, will be good for both Wall Street and Main Street, which I thought was kind of interesting. Like something that I've looked at somewhat recently is like looking at even the S&P equal weight index that you kind of mentioned, but more particularly what I was looking at was like the Russell 2000, kind of showing like, hey, yeah, we know big tech and a few other AI indirectly related sectors are crushing it over the last few years. But Russell 2000 is still kind of near its 2021 all-time high, and S&P equal weight, hasn't done super well. And then probably mainstream, like small businesses, may still feel that they're struggling. What do you make of Scott Bessent saying like, hey, next year will be good for both Wall Street and Main Street?
Right. So, I tend to agree, right? Solely for the reason that if you take a look at manufacturing PMIs and services PMIs, right, these are surveys to purchasing managers in both the manufacturing sector and the services sector. Obviously, the US is increasingly a service-based economy, about whether or not last month was better for them or worse for them. And this is an index that oscillates around roughly 50. It oscillates around 50. When it's over 50, we're in economic expansion. When it's under 50, we're in economic contraction. And for the last 3 years, as the Fed raised interest rates, it's been essentially flat, right? You never, and I mean never, you never see this index value not oscillate, right? Or at the very least, you never see it not in expansion for a protracted period of time. But that's exactly what we've seen in both manufacturing and services. Those two sectors, the two primary sectors that make up the entire US economy, have basically been saying, last month was no better or no worse than the month prior to that, right? And so sentiment is terrible. And that's because of the extremely high cost of capital. And so what Bessent is saying is essentially, as a result of what the Treasury's actions are over the next year and what the Fed's actions are over the next year, i.e. expanding monetary capacity, expanding liquidity, easing monetary conditions, it will be good for both financial assets and financial institutions, as well as those on Main Street. Because those on Main Street, obviously, their primary concern is inflation, right? You go to the grocery store, particularly beef prices are insane. And for those on Main Street, largely inflation is what impacts them the most because they're relying on a customer base of people who live in their town or live in surrounding towns, these small businesses. They rely on prices being relatively stable. Price inflation is at 3%. That's unfortunately the new normal. I don't believe that's going away anytime soon. So what I believe he's saying is that through easing monetary conditions, of course, inflation will be higher, but it will lead to an expansion in manufacturing. It will lead to an expansion in services. And as a result, even though prices will be higher, the capacity for individuals, credit availability will be higher, and therefore business will be better for both Main Street and Wall Street. So it remains to be seen, but over the last 3 years, we haven't had really any kind of material economic sentiment increase across any major American sector apart from tech. And I do believe that over the next year, as the Fed expands its balance sheet, it moves from contraction to expansion, which it has outlined is going to begin December 1st, and it brings down rates. I think both Wall Street and Main Street stand to benefit in different ways, and inflation will still be a problem, but it's unfortunately always going to be a problem. So to close, I think Wall Street is going to have a much better next several years than Main Street. I do think that until price inflation gets under control, which in my mind, it won't get under control, Main Street is going to continue to have a bad time. And the American middle class is going to continue to be hollowed out as a result of this extremely high inflation. But that's unfortunately the reality that we're living in. And so everybody has to become a participant in some way or another in financial assets in order to get ahead.
Yeah, it makes sense. And to me, and probably to you, it seems like Bitcoin is one of the best ways to be participating there. Not financial advice, obviously.
Yeah, not financial advice.
Yeah. So Joe, that was really interesting. Like thinking about, ISM in particular, like I've seen people bring up that chart kind of showing that like the last few years, ISM has, not really been an expansionary period. And historically, like Bitcoin's bull markets have correlated very closely with ISM being in an expansionary period, and once that kind of shuts off, that's when Bitcoin bear markets start. Do you think there's evidence that that's the case? And like, do you think that if we do see, uh, manufacturing and services start to accelerate again in the US, will Bitcoin be like one of the main beneficiaries of that?
I do. So this is actually a chart of Bitcoin overlaid with ISM manufacturing PMI right here and ISM services PMI, right? So expansion and contraction in both of these sectors. And what you'll see is that, and this is why I don't think the 4-year cycle has ever really mattered all that much. And if it did matter from a supply shock perspective 1 year after the halving, then I don't think it's going to matter anymore, because the marginal supply coming online for Bitcoin every 10 minutes is so small. Anyway, you take a look at this. Actually, Bitcoin's bottoms and tops, relatively speaking, have more or less coincided with the peaks and troughs in the U.S. economy, right? So you can see here, let's just take a look at manufacturing for a second. Bitcoin's rough bottom in 2015 was about 3 or 4 months from ISM manufacturing troughing, right, from the bottom in ISM manufacturing. And as the U.S. economy re-expanded, you can see Bitcoin once again went on this parabolic bull run all the way up to its top. You can see here again, obviously Bitcoin was in this huge bear market. Just as the U.S. economy moved from contraction to expansion, it expanded on its bull run again. Now, the amazing thing is that, of course, as the U.S. economy contracted, Bitcoin fell in price as well. But what you'll notice is that even though we haven't moved into outright expansion here from a manufacturing perspective, Bitcoin managed to rise from $16,000 all the way up to $126,000, right? That's the remarkable thing to me, is that despite the US economy not expanding from a manufacturing perspective, Bitcoin still did well. And so Bitcoin's bottoms and tops are much more aligned with the state of the U.S. economy and whether or not it's expanding or contracting than the 4-year cycle. It's basically just privy to the business cycle and the credit cycle. That's it. It's an asset in a universe of other assets. You'll notice this too in services. Services are much more important over the last several years, as we've made this transition from a huge industrial base for the global economy to a more services-based economy. Obviously, this has been underway for the last 20, 25 years. You can see here again the exact same pattern. Expansion, Bitcoin's price rises. Contraction, Bitcoin's price falls. Expansion, Bitcoin's price rises, and so on and so forth. We had this double top here that coincided with services basically being at their hottest point ever. The services sector of the U.S. economy being at its hottest point ever. And as services activity has contracted, again, Bitcoin managed to rise. And so as the cost of capital comes down, as monetary conditions ease, and once again, both the manufacturing and services side of the U.S. economy move from contraction or modest expansion into outright expansion, then Bitcoin and all other asset prices stand to do well. We're at the cusp of the business cycle expanding once again. We're at the cusp of the credit cycle expanding once again. Don't overthink it. Bitcoin is much more sensitive to these changes than basically every other asset. It stands to do well over the next several months, over the next several years, should we not enter into recession as a country, which doesn't seem like it's on the table.
Yeah, thanks for sharing this, Joe. This was really great. And I tend to agree. It's like, this is almost one of the most bullish Bitcoin charts of what I've seen fairly recently, where it's like, hey, the Bitcoin parabolic movements have historically been correlated with like a hot US economy, like a real hot US economy, not just a hot financialized economy where the S&P 500 or Mag 7 goes up. And it seems possible, if not likely, that next year, after government shutdown, Trump, has midterms coming up, wants to make sure that, everyone's feeling good about the economy in the future. At that point, it seems like if we can get the US economy hot again, Bitcoin could be on the way to have a pretty good year. Time will tell. But I agree, it's kind of dependent on the business cycle at this point, which is quite interesting.
Absolutely. Yeah. The one way to put it, and I'll add this note, is that zooming out, thinking about literally nothing else, the president of the United States, he wants asset prices way higher than they are now, right? Fed Chair Powell only has a handful of months left. We're going to get an extremely dovish Fed chair very soon. Trump is doing everything within reason, well, not within reason, but within his power, and even extending beyond his power to make sure that asset prices go up So beyond that, don't overthink it. The midterms are coming up. 2028 is coming up. He's going to want to make sure JD Vance gets elected. He wants asset prices much higher than they are now. So in that environment, do you want to be long or do you want to be short? I think that's the primary question.
I think that's a great place to leave it. Well, Joe, thanks again for doing this. It's fun to hopefully be doing this more regularly, talking about markets and macro. Any closing thoughts or where the audience can learn more about you and what you're doing?
Absolutely. Joe, thanks for having me on. These are always fun. I would say, late November, mid-December, we're probably going to continue to experience chop. Until then, the Fed is on the cusp of ending QT. We have another rate cut that's in the cards so far for December. Monetary conditions are going to continue easing. The government is slated to reopen. All of these great things from a macro perspective are on the horizon. So there probably will be more chop for Bitcoin, but understand that over a 5, 10, 15, 30-year time frame, as you always say on X, Joe, Bitcoin is the single most asymmetric bet that's available in markets today. That's my closing thought. If you want to find more from me, you can just check the YouTube description if you're watching on YouTube, or just go to my handle. It's spelled the exact same way that you see it, at Joe Consorti, to find more of my work.
Awesome. Well, thanks, Joe, again, and thanks everybody for watching.
Thank you.